Hello, I'm Jason Kelly. Thank you for joining me today. In this video, I'll look at more evidence that stock market analysts are useless. I know, we never run out of this source of material. Today, I will do this with help from Sarah Gordon at the Financial Times, who recently summarized today's installments. Now, I've called analysts Z-Vals for years. That comes from Daniel Kahneman's book, Thinking Fast and Slow, where he described political forecasting and stock market forecasting as zero validity environments for the basic inability to forecast anything in them. So I shortened that to Z-Vals in reference to those environments, specifically the stock market, and the Z-Val commentators within that stock market who dominate media all the time because it's so dramatic to say, stocks are going up, or stocks are going down, or buy this, sell that, etc. When in fact, you should just be running a system of rational reaction, the way I do. Now, here's the installment from Sarah, starting with the list from Sarah Gordon at the Financial Times. A 2002 academic paper found that analysts just follow glamour stocks. And I'll show you an excerpt from the top of the academic paper here. It'll be on your screen. The headline of the paper, Analyzing the Analysts, When Do Recommendations Add Value? Highlighted from the abstract, we show that, consistent with economic incentives, analysts from sell-side firms generally recommend glamour, i.e. positive momentum, high growth, high volume, and relatively expensive stocks. Naive adherence to these recommendations can be costly. They certainly can. They're just stock cheerleaders looking at what's hot in the headlines right now. The companies getting all the attention, the companies sponsoring events, the companies with new products, the companies who are hot on blogs and social media, and so on and so on and so on. That's what the analysts want to glom onto because that's how they get more attention. And they're almost invariably positive on those stocks because they're being presented positively in media. In April 2013, so coming up quite a bit more recent, that last bit of evidence was from 2002. Now we're up to 2013. The personal finance website NerdWallet reported that 49% of analyst ratings on the 30 components of the Dow in 2012 went wrong. There are key findings from their report that I'll show up on your screen in a second here. Key findings. 1. Only 51% of all analyst ratings on the Dow 30 over calendar year 2012 were correct. Point 2, highlight, the average analyst portfolio just slightly beat the market, so not worth a whole lot. And point 3, analysts are better at identifying winners. With over 70% of buy ratings correct, buys made up about 85% of all accurate ratings. Let's think about that for a second. Of course they're better at identifying winners. The reason stocks are in the news is because they're winning, usually, at least the ones these guys recommend. But there's more to it than just that. The stock market, historically, has risen twice as often as it has fallen. It goes up 2/3 of the time, goes down 1/3 of the time. So if you're in the odds business, you're making predictions, and you want the odds in your favor to be right, you recommend long ideas. You recommend buying a stock. You recommend owning stocks if you're going to be rated on this. And analysts are judged by their ratings. So, of course, you more often recommend buying than selling. The odds are in your favor. The wind is at your back. But the more important point is not whether they were right or wrong by guessing with the odds. The point is you don't need these guesses or recommendations. You already know the market goes up twice as often as it goes down. So, yes, you should be in the market most of the time. In fact, all of the time by my system, but just adjusting the allocation between stocks and bonds. But the point here is they are recommending basically what the stock market already does, so no value in that whatsoever. Now, the strong odds of the market rising is why almost no analyst ratings are sell. That's where we get to our next bit of evidence here. In February 2015, Bespoke Investment Group put a finer point on this. They reported, or CNBC reported on this look at it by Bespoke, and I'll put it up on your screen here. So this is from the story by CNBC. The highlight reads, of the 12,122 ratings there are of companies in the broad market index, just 6.67% carry a sell label. Just 6.67%. And down below the next paragraph, we see Bespoke's Paul Hickey said in the report that the, quote, percentages are roughly in line with where they've always been, end quote. In fact, the level of sell positions increased slightly from the last time Bespoke looked at the trend in August. In this roundup of evidence, we see analysts chasing the same glamour stocks they always chase, the same ones that are in the media, and not issuing sell recommendations. In other words, going with where they know the market is most likely to go just based on historical evidence, which sounds like, well, they've gotten it right, haven't they? Not really. That's like somebody predicting the sun's going to come up tomorrow. That's a pretty good prediction, probably guaranteed to be true, but how useful is that to you? You probably already could have guessed that one yourself. And so it is with these analyst recommendations. If all they're saying to do is own the stock market, they're correct, but they're also not providing any value to you. I cannot overemphasize how quickly you should get your money onto a system of rational reaction, looking at where the prices went and adjusting accordingly on a quarterly basis. That's what works for me here at the Kelly Letter, quarter after quarter after quarter, beating the market over time. If you like this video, please do like it. Give it a thumbs up here on YouTube and subscribe to the channel so you can get more videos like this in the future. Kelly Letter subscribers, I will see you on Sunday. Everybody else, have a great weekend. Thank you for watching.